I'll click start streaming, wait 3 seconds or so for it to go live. Actually, today it looks like it went live instantaneously, which is always a beautiful thing. Which means, ladies and gentlemen, boys and girls, traders of all ages, the TradingView show in 2024 is live. We are here with David Russel from TradeStation. And what's very important about this show is that it's sponsored by TradeStation. And TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures options, and cryptocurrencies markets. So it's great to have TradeStation here and them as a sponsor. You are talking to David Russel, the global head of market strategy. My favorite thing about David is, well, first of all of you should go back and watch some of our other live streams to see what he's walked us through, some of the observations he's made, because many of them have played out rather perfectly. As we get started in 2024, this show will help you get ready for the new year. And lastly, David is the man behind the TradeStation account on TradingView, so be sure to follow that account, leave comments, boosts, and likes. You have direct access to David whenever you need it. Send them a DM, all that good stuff. So, David, I will now pass the mic to you so that you can give us the introduction that you need to give.
Well, thanks, Seth. It's great to be with everyone. I hope you're having a great 2024 so far. So we're just starting off by showing some standardized returns of the ETFs that we may or may not be talking about. Just want to share those in case we do discuss them. You can see them now. And as Steph mentioned, it is earnings season, and I have Tesla this afternoon, and lots more interesting names coming. I want to just quickly mention that here on our TradeStation platform, this is just TradeStation. I wanted to quickly show you. This is like a calendar that allows me to see the upcoming companies. And what's interesting about this is we can sort it by when they're coming, their earnings are coming out, and we can also basically filter out companies. This is the NASDAQ 100. We can filter them out. This is the average options volume. And we can say, I only want to see like companies that maybe trade 50,000 contracts a day. Now, this is a little kind of proxy that I use for, for companies that are highly active. So in this case, these are the highly traded names. We can just single out the big active names. Like you can see, we have all of our big, well-known growth stocks like Microsoft and Apple in here. And then I can just kind of segregate them out by simply sorting by the size of the amount of volume. And then I can just go and line them up, and you can see them in order. And there's a good way to kind of plan and anticipate the earnings season to know what's coming. It's always important to be knowing stuff and to be looking at chart levels going into that, because maybe there's something where there's a potential breakout or something like that. Steph and I were talking about how sometimes, patterns don't play out as expected during earnings season, but levels still matter. And it's important to kind of know, are we going into earnings season at a time when a stock has already been running and it's already priced in a lot of good news? Or are we coming off a low? Or are we at an intermediate term basing pattern that we're now seeing a breakout from? We recently did an idea on Textron, and that has a classic intermediate term breakout today on earnings. So this one of those examples of, a long basing pattern, a long consolidation, and now there's potential for, maybe potential upside. We highlight that one at the time. So I wanted to show this to people before we jump back over to, well, actually, this one we wanted to start with. Steph, we talk about how, first of all, I wanted to just say that, in my view, working, since pretty much the year 2000 in the U.S. equity market, this is the most positive macro environment that I believe I've ever seen. It doesn't mean it's the most positive environment for the market overall. If you think of something like March of 2020, April 2020, you were coming off such a massive low, the risk reward in some cases in that moment was more favorable. However, the overall situation of what's happening, in my view, in the market and what's happening in the economy and what's happening in terms of where investors are demographically, where they are in terms of psychology, is, the most favorable overall environment that I have seen, I believe, in my career. And I would point us back to 1995. I continue to believe this is comparable.
So, David, I have to say on that note, which is very interesting to think we kicked it off with earnings reports. First earnings reports of the new year are coming up. Of course, they're for the last quarter in 2023, but nevertheless, still the first earnings report. And now we are connecting that to this large pile of cash just sitting on the sideline. That is very, very interesting. I don't know what to make of that, but you had mentioned to me that sometimes earnings reports are liquidity events, and I thought
Yeah.
that was such a cool comment because I've always wondered if you ever look at a chart, 90% of the time the highest earnings day for a particular stock is the earnings day. So walk us through some of those concepts and connecting the dots there. I think that's so interesting.
First, this is on the Federal Reserve website. If you Google Fred, which is actually the St. Louis Fed has a data tool. If you Google Fred money market funds, you're going to find this chart. And basically, what's interesting about this is you often kind of find that when the market bottoms, this peaks and it starts to come down as the market rallies. So what's interesting is that we haven't even hit a point here where the money has started to exit money market funds. So when the market bottoms, like if you look at other moments in time, what you can actually see is that, this was in like 2020, and then money starts draining out of money market funds into the stock market. We haven't really seen the money draining out of money market funds yet, and we're at an all-time high. So if you look back here, this was February of 2009 when there was the most money in money markets, and then it drained out into the stock market for the next 7-8 years. And then basically that's when the market was rallying, basically into the the following years after the financial crisis. But now it's still going up. So we're not even in a spot yet where that migration of dry powder exits money market. So to me, that's important. And I think it's also important to realize that, earnings are often liquidity events above all else. It's a time when there's a lot of volume, and there's a time when if people want to buy or sell, whatever it is, the opportunity is during earnings season. And so I think right now what we're seeing is there's money on the sidelines, the market is breaking out, and people are putting that money to work. And as I think we're going to get back to after, I want to walk through in a minute. After you look at some charts, I want to walk through just to really emphasize why this macro environment is so positive. I know we like looking at charts here, but you also have to sometimes have a little bit of a sense of what's happening behind the charts. And in my opinion, there's some really powerful forces that not only are at work, but are actually increasing as we speak.
I have to say, on that confluence of events of a bullish macro environment, money market funds at all-time high, and earnings reports beginning, I must say, if there is a large number of earnings beats or surprises, that sounds like rocket fuel to me. So I just put that together. That will be on my list of things to watch. Even if there are lots of misses and stocks start gapping down, that's equally interesting because now all that cash on the sideline has potentially the entry point they've been waiting for, right? A large flush out. So maybe watching for dips to get bought up. David, this is the exact start to the show I was looking for, and I hope everyone listening just got tons of information on what to pay attention to for the next 30 days. Okay, I'll let you take it away because now you've got this great chart up of the S&P 500. I always love these long-term charts. Walk us through it.
So it's a weekly chart. We've been looking at this since you and I started doing this, these conversations, and we had talked about this kind of pattern that has appeared repeatedly. I call it the kind of 18 to 24 month. These are weekly candles, but it's an 18 to 24 month basing or topping pattern, and with a breakout. And it's not exact, but you can see it happen back here. And then after right before Obama got his second term, we had that breakout. It was after there was a debt ceiling, all that stuff. Had a rally, period of consolidation. Then it rallied again after Trump took office, and then basically this one happened. There was a period of consolidation here after the Chinese trade war ended. We broke out, and if it hadn't been for COVID, there's a good chance that this rally we really saw in 2020 and 2021, this was more or less the pattern we were in place. So what we see now is that basically we've held the bottom here, and in my view, it's not outrageous to be thinking of something close to 5,800, over this move here. And I think as we look at this, this is the channel I'm watching. Now, if we go back and we look at the late 90s, what we can also see here is we see similar sort of things back here. And we basically had, this was a crash of 87, and then this was late 94, early 95, when the Fed pretty much stopped raising interest rates right about there. And that's more or less, so if you look at it, I did a TradingView idea a few months ago, kind of saying that it looked like is where we basically were, a comparable sort of period. So these patterns continue to play out. And I think it's important to kind of have a look at that. Now, the other thing in terms of signals, I'm going to jump back over here to the current day. We basically saw in the S&P a record weekly close, not an all-time high, but a record weekly close was right back here at the week that began January 8th. And so once you start kind of, teasing or touching those highs, there's a tendency, you might chop for, a day or a few days, but there has been a tendency for continuation and follow through. And we saw this on the NASDAQ as well. What's interesting here is the NASDAQ had a high back here in early December. This was kind of the foreshadowing of what was coming. The NASDAQ closed at an all-time high, consolidated for about a month and a half before it continued. So in my opinion here, we have, we've seen these patterns developing on the weekly chart here for a while. And there's some stuff on the daily chart now I wanted to show as well.
David, really quickly, going back to that S&P 500 weekly all-time high close, I would love to just point that out for a second, because I think that is a great observation from the standpoint of most people look at the chart and they think, oh, it's not actually at an all-time high yet, because look at the wick here, right? That was the all-time high. But if you consider the close being sort of that definitive moment of this is where it closed after a full day of trading, it represents an entire week. That's such an astute observation of gauging all-time highs. I just wanted to point that out because I had missed that even though it wasn't at the top of the wick all-time high, it had an all-time high on the weekly close. That is very interesting. So I just want to point out that observation for all of our viewers.
Thanks. Yeah, I'm going to add that, just the label on that. I will admit, one of my vices, I have too many charts and I have labels on some and not on others, and I forgot this one didn't have that label.
Do you always look for that, by the way? Do you always look for the weekly closing highs? Is that something you've learned to pay attention to?
Yes, and I would say I've been watching for this pattern for the last 3 or 4 months. I was aware of this sort of longer term pattern, and I was waiting for confirmation of it. And so once we started hitting it, I think I did a TradingView post at the time. I think it was called New Highs in the New Year. I think I did it sometime in December, and it was on the S&P, but it cited the NASDAQ, and it more or less cited the same sort of weekly, because the NASDAQ did it first, and given the NASDAQ's dominance in the market, it's the one that makes more sense to, it makes sense to focus on. But I think if we look, we can actually, if you want to take a look, I think it was called New Highs in the New Year. I did that not that long ago in December. But anyway, yep. So that's it. So the thing is, we were waiting and watching for this pattern. It made a lot of sense. And my thesis all along was that we were not going to have a recession and inflation was going to come down. It was a classic soft landing. And I also, I was looking at the fact that negativity was so high. And on top of that, I was looking at what was happening with things like not only AI, which is a huge secular growth driver, but there's also significant value in this market. The financials are at a spot here where they can ramp up earnings. We also have a situation where there has not been a lot of M&A for years. So M&A can become a catalyst as well again. We're starting to see these job cuts. eBay cut jobs, SAP cut jobs, Google's been cutting jobs. All those things mean what? Profit margins. And we're going to get to this later, Steph, but profit margins there's evidence now that they've actually bottomed, and we're going to see an improvement in profit margins this year. So these are some of the fundamental things that are in the background.
So I want to add to this, by the way, I found your idea, New Highs in the New Year. I put it in the chat. When this goes up on our YouTube channel, I'll also include it in the description. So anyone who has heard David just reference that, you can click the link to read it. And yes, going into some of the layoffs in tech, I think that's so interesting because it took me a while to understand this. I remember when I was first getting started in markets, companies would announce hey, we're laying off X number of people or X percentage of our workforce. And you'd go check the price of the stock and it would be spiking. And it was so interesting to me to put together like that sounds like bad news, but actually, as you just said, it could mean greater profit margin. So it's a hard one to wrap your head around, and I'm excited to sort of walk through it with you.
Well, I would just very quickly say that for the most part, if a company needs to cut jobs, it means they've already had problems and they're probably struggling, and the market will know that. So the fact is that if they're cutting jobs, they're responding to something that is already out there. So I think that's the way to think about it. The market knows everything, and normally the badness that they're trying to overcome will have already been in the price. So now we'll look at the daily chart. There's a few things I want to mention here. This has RSI. Now, wait a second. All right, good. RSI, I've noticed this pattern. Now, this is a short-term tactical pattern. It can often occur in a downtrend. It can suck you in and for new lows, but it can be a short-term pattern, and I call it RSI breakout. And I've just seen these sort of things here where RSI will have these sort of, it'll go down to these deep levels of oversold kind of despair. It can't make new lows, and then it rips higher. And you can see that at different moments in time. And I want to just point out that we have one of those again. I've normally seen that when the RSI, when the purple line, I'm not sure what you call each one of these here, but there's the moving average, which is the yellow. But when the main signal starts rising above the moving average, it tends to signal a period of kind of shorter term strength. So we did have that here. Now, some other signals I wanted to put on here because I wanted to use some of our custom indicators to show very quickly. One of them is called days since MA cross. It's called bars since MA cross, and the other one is price streak.
Oh, this is so cool. Are these all TradeStation scripts?
Yep, these are some of our custom scripts that we've they're available on our profile. If you go to the TradeStation brokerage account and you go to scripts, these are available to anyone who wants to import them.
I think
so.
I'll just say quickly, price streak is one of my favorite scripts that I've learned that you all coded. Okay, I'll listen to you. Walk us through it.
Well, I just say right now, remember, folks, we have GDP in the morning. There's some fear hot GDP is going to push up interest rates and the Fed won't cut rates or whatever. So, I mean, there is some risk to that. The S&P is up now for 5 days in a row. I'm watching as the VIX kind of inches off the lows of the day. So I want to just kind of point that out. You could kind of say the market's kind of, had a decent little run here. And if you see, you can just see, all right, up 5 days. So the question is, do you want to buy the fifth up day? That's always the kind of question I think people should kind of work through, just to realize where we are in the short-term cycle. But now the other signal that I think is very interesting, and I should have left RSI. Let me put I think I can put it back on. All right. So that's price streak. I'm going to take it off quickly so it's not overcrowded. This shows, so a lot of people use the 8-day exponential versus the 21-day exponential moving average as a signal. So on this chart, it's the dark blue and the gold-colored moving averages. When the fast one is above the slow one, it's a short-term bullish signal. But the thing is that you can actually look at this and you can see that this, I created an indicator to show how many days has the condition been true. Because the fact is, the condition will often be true for 3 or 4 weeks before the move even starts. And then the thing is that it might stay true in a bullish short-term trend for months and months and months. It can last this way for many months. So if you look at the current pattern, this is a little bit of an overbought, oversold. It's more a question of how long has the move been running. It's not based on the price, it's based on time. And this actually shows that we've been in this condition for 53 candles. We were in a longer condition back here of over 90 candles. But if you look back historically, we're nowhere near an excessive level. So what's interesting to me is this market could kind of, if you look at history, we could remain in this sort of bullish short-term pattern for many months based on history. And, any pull, what does that mean? It means a pullback under the 8-day exponential. Anything near the 21-day would be trend following. to be entering at those levels. You can see here how we held that 21-day. It's also interesting to me, if you look at the tightness of this pullback, I was really honestly hoping and looking for a pullback here, and we didn't get it. I mean, that's the thing in an uptrend. You just don't get those deeper pullbacks. There are not a lot of sellers. You look at these moves coming off the lows of late October. There were no pullbacks. These are very tight consolidations, and this is a signal of a market that is under rapid and aggressive accumulation. And I think that's important to recognize here, is that this does not happen at the end of a move. This is actually, consistent with the beginning of a longer term bullish move. So when you see that 8 and 21 here, this says that even if we've been running, it's not dead now. Let me just very quickly go back and compare this to 1995. This is a daily chart, so I have to drag it back some. But what's interesting here is if you look back to 1995, these conditions actually, look at this.
Whoa.
It remained in a bullish sequence for 260 candles, which is a calendar year. Now,
is that must be a
RSI,
record.
I think it is. So if you want to understand the rally of 1990, if you want to understand the late 90s, you have to understand how the move began between 95 and the first part of 96 here. This move was, look how smooth that is. Now, our current behavior is looking very similar. So it's also important to realize at that time, RSI, now look back then, RSI, look at this straight up. Now, look at how RSI went overbought and pretty much never really went under 50 for, all the way through to like October. When was it? I mean, you're looking here, if you kind of scroll this out through time here, I mean, you're looking at something that, you got to look well into like the middle second half of 95 before we saw any kind of pauses here. So to me, this is very interesting, and this shows a strong accumulation. Everything about this trend was a positive short-term trend. You can go overbought on RSI, pull back a little, and go right back to overbought and stay overbought. And that is symptomatic of a strong uptrend. So I want to point out these patterns look similar here.
I have to say that I did not know that about the 1995 bull market. So that was a really cool history lesson. I think it's possible a lot of viewers are not, they weren't trading at that time, so they may have just learned something new as well. And as they often say, right, history is the sort of our only thing that we can study in markets. So one other component I want to add to that is, even though that, there's that trend going on, I'm just amazed that it kept going too. It was really just the start of something into the .com bubble. And it was, you'd think that bull market can't continue, but it went right into the .com bubble. It's fascinating to see how long those bull markets can last for.
I don't think the Fed money market data goes back that way. A second. I mean, if you look at,
oh wow,
I'm not sure where. This is not maybe as useful. I don't know here if this is as useful. But the key thing is that at that moment in time, there was a lot of negativity. There were people worried about the return. There was this kind of brief recession in the early 90s. Everyone was scared it was going to come back again. And there's a lot of negativity. And then everything just melted in the right direction. And, right now, I think we look at inflation and the other things that are happening. There's definitely problems in the world. But the fact is that from an economic perspective, they are getting in a positive direction. So I want to just point that out, because I think if you look at this in the long term, on this shorter term sort of pattern, when you see very often, you look at stocks that really, when a rally starts, you're going to see something at the beginning of it that kind of says, this is a significant, these things don't just happen in isolation. And to me, this defined the late 90s, and we could be in a similar sort of moment now. And I think people have to just realize that, there are similar conditions, and it's not just my opinion based on a few economic numbers I look at. There are similarities in the charts, and the tightness of these pullbacks at the same time there's so much money on the sidelines really suggests that there's not a lot of sellers.
I have to say, on the comment that you've made about the pessimism and it being similar in the 1990s, I'm sure the crash of '89 had a big role in that, maybe other political or macro factors. But that pessimism being similar today, I always find fascinating because your point makes me think of that John Templeton quote, which I just looked up. Bull markets are born on pessimism. And that just clicked with me as you were saying that. And it makes sense because it almost takes off before people start to accept that, oh, maybe things are better than I thought. So excellent history lesson. And the full quote is, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die of euphoria.
Yep, that sounds about right. And we're not to that point yet. And I would add that an election year historically is a time when you're more likely to see a sense of positivity about conditions. You're going to see politicians talk about things or people look at them, whatever it is. And I think that has that potential. Historically, whatever you feel about the people running for president, there's a pattern historically. I mean, you look at 2008, it was different, but historically, election years have this sort of pattern of a kind of confidence in the economy and of things are going to be good and optimism and all that sort of stuff. And so that's another thing to put into it.
No, you had I think on a previous show, or might have been us chatting about that, opened my eyes up to that concept of elections, which is right, when people are running for office, it's in their best interest to get the market going, to get things feeling a little better. And that's probably why sometimes election cycles are bullish for markets, because everyone's trying to get things rocking and rolling again. Something I learned something new on these shows each time. So now I see you have a chart up of the euro. Walk us through this.
So we have a lot of things. I mean, the economy has continued to have some strong numbers, and the Europeans have a central bank meeting tomorrow. So it's kind of up in the air, GDP tomorrow. I did want to just point out, though, we've seen multiple breakouts of these kind of falling trend lines. I mean, it's interesting. I think we wanted to see if this pattern repeats itself. I right now have no real view of the euro. I see the potential for it to break a pattern like this. But at the same time, these bounces have worked. And, I think when you consider the strength of the American economy and some other things, this time it might not work. I want to just point out that I think we're at an interesting sort of point for the euro, and it could kind of extend. However, this pattern resolves and it breaks to the downside, it could kind of revisit these lows from October. So I think tomorrow is a big day for the euro, although I look at currencies and I don't always have views on them. To me, there's times when there's a really clear pattern or something important on the currency charts that we want to pay attention to. Right now, I don't see that. But I think it's really good here because, we looked at this historically, but, gold actually over here in this chart, the weekly I wanted to show, gold here is basically, I think, setting up for something of a false breakout. And I think if the euro weakens and gold goes down, that actually confirms the bull market in equity. So I wanted to just, mention here that gold, I think, is also in a spot where it's, it could have some potential to go back down and fill this gap, fill this range a little bit. And I think there's people who basically were long gold, betting the Fed was going to slash interest rates. And if it doesn't pan out, then, we might end up in a situation here where there could be some selling in gold. And I think this false breakout, it's just trying to hold above 2,000. And I think this is kind of interesting to see. My suspicion would be that odds more likely favor downside in the euro, downside in gold, and continued strength in equities. And I think this just something I wanted to point out.
I love this gold chart because it's such a massive commodity based off of its market cap. And it's at this multi-year resistance, and the false breakout is just perfect, right? I think there's some sort of saying about how when the breakouts turn into fake outs, and that to me is just almost textbook, and it looks like a triple top to some degree. So this gold chart is so interesting. I'm watching it, and by the way, I know a lot of people who are trading gold, so they'll also find this worthwhile. To me, it looks like it might, down or sideways. It just looks heavy. Is sort of my thinking.
My sense is, back to these levels from early October, potentially a range. There will be a time when the Fed does start cutting rates, but we might need to be further along in the cycle for that. We might need to see more money in the S&P, and then as the market pulls back and the Fed cuts rates, then that'll be different. And that could be, 2 or 3 quarters from now. So the other one I got to look at, though, is Bitcoin, because there's also a level here on Bitcoin. I think it's important, 48,000. I want to just mention here. This was just, level that I've been kind of watching. I don't really have a view about Bitcoin or cryptos here, but I wanted to just mention that crypto is also kind of at a spot here where, it's it has some resistance. And I think, we have to be careful that this had a good run. It's in a range. And when things are at the top of a range, we have to be careful, assuming they'll break out or assuming there'll be more upside. Very often what I've learned is that, we go back down and fill some or all of that range. So I wanted to point this out in Bitcoin.
And question for you about Bitcoin and also gold. I was meaning to ask you about gold. How do you use gold for your research? Or is there another way that you use it in your research for others to learn, of course?
Well, I use it as a sense of economic weakness. So it can be something for fear. Although the problem with the fear trade is that the fear trade can lift the dollar, and that can go against gold. So for me, I just view it as a proxy for dollar weakness and euro strength. So I would say that if we started to see jobless claims go up, the economy weaken, that would be something nice for gold. And I would think that right now, the gold will be your best forward indicator of Fed funds and what the Fed is going to do. If we think the Fed's going to cut, gold's going to rally.
Got it. So that is a good tidbit for listeners, even myself, of using gold as that indicator for the Fed's next move. And then how about, just curious about Bitcoin before we go to the VIX, which is, wow, what a chart. What is your thinking about the post-ETF movement? Does that seem like a typical buy the rumor, sell the news event, or what are your thoughts there?
It does. And if anything, to me, I've been more concerned that it will be a bearish thing because now it's easier to short Bitcoin. And so I think that it's, after Bitcoin launched its futures, it went bearish. People could short it. So I think that, that is not necessarily a bullish thing. I think that in some ways this was kind of, this might have potentially been the end game of Bitcoin. Now that it has that ETF, the question is, what else can really be the thing that makes it appealing? And the thing that makes me concerned is that everyone says, oh yeah, gold rallied after the GLD was launched, and that's true. But we also basically saw a massive rally in the euro and global the global economy coming out of SARS in 2002. We had the end of basically they had the Asian debt crisis in the late 90s. You had the Iraq war, you had SARS, and coming out of that, we had a monster wave of globalization. We saw certain things about the American economy really favor global assets. Our debt, our trade deficit as a percentage of GDP hit the really high level, 70% of GDP. That all favored weak dollar assets and global assets. So I think people often, it's a little bit of correlation and causation, or just maybe the GLD came at the right time. But I think the idea that gold rallied because of the GLD, I don't agree with. I think that was a contributing. It didn't hurt, but the real factor was that basically the European economy took off because a lot of the integration that happened with the launch of the Eurozone right around the year 2000 paid off. And you saw a bunch of countries like Greece leverage their economies. They grew quickly, but then they crashed. But during the period of growing quickly, the euro outperformed. And I think that dragged up global assets with it. And gold was the key place to be. So I don't think it's a good comparison.
In a lot of ways, one thing that I learned from you is the market history. You're a market historian in many ways. And so just to give our viewers context, tell them about GLD and exactly what that is, because some people may not know.
GLD is an ETF that tracks gold. It represents 1/10 of an ounce of gold. It debuted in right around the year 2002, and gold, rallied around the same time. But one of the other things is that the Fed had interest rates at a very high level in 2000, 2001. and they started cutting them. So there were a lot of things happening. The dollar, if we look at the long-term dollar index, the dollar was at, really a very high level at that period of time back in 2000. See here? And then basically this is what made gold go up, in my opinion. It wasn't GLD. It was the downside in the dollar, and the euro went up in the same period. So I think that this is a dollar index. So basically, to me, that is really what drove this. The GLD launched around the same time. If you look at its history, I think when was it? It was 90. It was 04, and everyone said, "Oh, the GLD made gold go higher." I mean, like again, didn't hurt, but there's a lot of products where ETFs launch and they don't necessarily take off. So I just that reasoning, I believe, is not super super strong. I think that there's a lot of correlation there more than causation.
So interesting. And the reason I'm just putting this together, GLD is essentially the first time you could have bought gold in an ETF format. Is that right?
Yeah.
Wow,
Before that, people had to buy gold mining stocks.
Got it.
And they did. And in the 70s, gold miners were very popular because gold was strong in the 70s as well.
Well, excellent history lesson. And that's the first time I've heard the comparison of the Bitcoin ETF to gold ETFs. And for viewers watching who are following Bitcoin, that's some research, or that's some Wikipedia articles to go read. And I think it'll make for some very interesting reading. And now this is the dollar chart in the present moment, right? Is that what we have up now?
Yep. And to me, it looks very neutral. I mean, this drop, it retraced half of it, and you could say that was bearish. And I think it was at the time. But to me, right now, this is a very kind of a neutral situation. I think the American economy right now is very strong. You can watch some of my other webinars, and I explain those things that are happening. I'm going to quickly mention them. But to me, right now, there's really nothing clear happening, with the currency market. I mean, there definitely can be moves, but I don't see any clear trends that people can easily capitalize on the way some of the other things. Like we had highlighted the downside in the dollar coming off this 50% retracement. We did a TradingView idea at the time, but it to me it's not clear right now.
Yeah, it's an interesting one. Just at my first glance, it looks clear, and I'm surprised at how the range the levels you have marked there, it looks like a really narrow range at the current point. And I think those are is that's a Fibonacci extension you have there?
Yeah, Fibonacci retracement of this drop is right there. So it hit the 50%. But then you have a higher low. And then you have some potential support here, So, if it's holding these old highs that go back really, at this point, 8 or 9 years, you can say it's holding longer terms, turning old resistance into support. And you could actually argue maybe that it's setting up for a historic breakout. And I think if you look at what's happening right now in the European economy versus the American economy, you could make a case that the dollar is going to rally against the euro in a long-term way. I mean, Europe is in a pretty bad economic situation, and likely it seems like it's not getting a lot better. The American economy is not in a much stronger case. So you could make that case. And at this point, I just think that there's nothing super clear that we can capitalize on.
I'll be watching the dollar, especially from the standpoint of inflation, just because that inflation word has been thrown around now for what feels like 2+ years. And I'll be watching these ranges that you have marked because of the narrow. It just feels narrow to me. What other charts do you have for us?
Well, look at the VIX here, because to me it was important to kind of look at VIX. If you look at historically, VIX can go to single digits. And I tend to think that's kind of what our base case should be here. When you look at where we are of the future of the Fed, the cash on the sidelines, the market just had a breakout. I didn't actually do it in this chart, but it would be interesting to look at when did we have those breakouts, like in early 2012, right around the S&P breakout we were showing was right around here, January of 12. And then the other one was the beginning of 17, which was, right around here. This is right when Trump got elected. And then I remember we had this incredibly low volatility. And then I remember in early 18, we had this spike in volatility because people were selling volatility so aggressively. And I remember it was his first year in office, and this is when the big NASDAQ names started running. But I think the key thing here is that this current environment, would be consistent with volatility going lower. And so I think it's we had talked about how this level here around 15 basically had been support during the so this was during the whole period after the pandemic, and then the Fed starts raising rates, and the VIX goes back up. But now this level around 15, it could be turning into resistance. And from my perspective, this potentially argues for lower volatility and continued strength in the S&P 500.
And that is for all the technical analysts out there, when that, because at one point it looks like 15 was support, so it's almost as if we're seeing that support turn into resistance. So definitely great level to watch. Noted. And VIX single digits doesn't happen often, but it can happen.
Next, we'll look at Tesla, because in my view here, Tesla is, we have some weekly patterns to be aware of, but this is a 2-week chart. I was going to 1 week, but I mean, we did this sort of noting how this, I think a lot of people are aware of this downtrend, but I think that Tesla's in a spot here where other members of the NASDAQ are hitting highs and Tesla has not. This is a case where the chart is doing your fundamental analysis for you. When you see something making consistently lower highs on the weekly chart for a period of time, when the NASDAQ made a new all-time weekly high a few weeks ago, Tesla hasn't done that in like 3 years. So this environment right now, I think that this is telling you that Li Auto and Xpeng Auto were coming. This told you that the competition was coming. This chart told you what we are now seeing fundamentally, that they're raising their wages for their workers and not raising the prices for their cars. This was all in the price chart on the weekly chart here on TradingView. So I think right now, we need to be kind of thinking of, potential with Tesla reporting earnings after the close. If it does start to break down, how far, where would these levels be? And I'm just targeting these. And, I've actually been, I've had trouble trading Tesla myself. I haven't owned it for a long time. I caught this move here and I was happy about it. But I haven't been able to, be super accurate with it since. So I'm not going to try and say anything too clear about it, but I'll just say that it does have this sort of the secular growth story, and the fundamentals on this are, I think are clearly in a weakening spot. And we see China pumping up stimulus and stuff like that, which I want to get to. But I think at this time, we have to just realize that this one is seems to be kind of broken. And there's these other things like semiconductors and Microsoft, hitting highs. In fact, I have to get to that one. If you have a second, let me get to that one next.
I just want to say quickly for the viewers, just to confirm, Tesla reports earnings tonight. You see the levels. You're on the live stream. It'll be interesting to see what happens with the price action. I'll be watching that downward trend that you noted, those 2 levels of support. So this will be interesting. Let's go to Microsoft.
Yep. So Microsoft on the weekly,
wow,
broke out to new all-time highs, held it. Apple, no. So I want to just point this out. Historically, it's pretty interesting to compare, and I don't have it in front of me right now, but if you look, during the 90s until about 2002, 2003, Microsoft crushed Apple. Then when it started with the iPod, not with the iPhone, but with the iPod came out in the early 2000s. Apple became a great stock again. And, it's possible that right now we're at another turning point. And I think the charts are telling us that, that right now we have a new era. And I think that in many ways, the last 20 years was about the consumer side of technology. The 90s were driven by enterprise, by people building internet and stuff like that. And also things like personal computing. But then after that, we saw consumer-facing names like Apple, but also Alphabet was, Google, that was consumer essentially. Netflix, amazing. Obviously, Amazon, Facebook, Meta, all of these, Salesforce.com is essentially an advertising company, in my opinion. It's really not a tech stock. It's a company that helps people market stuff. But now we're seeing enterprise again. And where are we seeing? It's the semiconductors, companies like Microsoft, companies like ServiceNow, companies like Adobe, which is maybe not Adobe so much, but ServiceNow, some of these other stocks, Snowflake has been breaking out, some of these enterprise names. No one goes, and even if everyone has Microsoft, but for the most part, if you go to work, who pays Microsoft? It's your company's IT department. If you buy a computer, but for the Microsoft makes its money from enterprise. And when they start rolling out AI, that's an enterprise thing. So right now, I believe we're entering a new era for technology that is enterprise focused, and Microsoft is in that spot. And in some ways, again, it looks more like the 90s. Apple is a consumer facing company, is not broken out on the weekly, and Microsoft has. So I wanted to point that out.
I would add to that, because I did learn this the other day, that for the first time in what feels like years, maybe a decade, Microsoft's market cap is larger than Apple's, and Microsoft
Yes.
is currently the largest company in the world by market cap. So this breakout compared to Apple really puts that into context. And that was very interesting to hear about Apple's iPhone moment compared to Microsoft, and that's when Apple took the lead. And maybe maybe it's the AI moment. Is that potentially one way to maybe think about this transition? And Apple's lagging a little, possibly.
It's absolutely AI, and that's an enterprise thing at this moment in time. It's basically going to be big data. It's going to be Azure, because what's going to happen is if you're a firm and you're building AI, you're essentially going to end up on AWS or Azure, basically using their tools and paying some kind of monthly subscription fee or whatever to run your AI on their platform, and then they're going to buy NVIDIA and AMD chips to power their their data centers. But this is enterprise. And I think it's just important to realize that. I do believe that the last 20 years was consumer tech, Apple, e-commerce, communications in terms of search, stuff like that. And I think that I think we need to rethink this now and to recognize that this is actually a new era, just a different chapter in the story of growth and technology investing.
That's really interesting. And for everyone who's watching me, if they see me typing, I'm writing show notes in the chat. And so I just called that, an observation about the changing tide from consumer tech to enterprise tech. So that's something also to walk away with for further research. I know there were a few more things you wanted to show us. I was just thinking about this too. Take it away.
All right. Well, today we have some news that China is going to pump up their economy. This is the FXI. We've been very negative on China because of their structural issues. And I want to just mention that sell the news, is going to be one of those things. Trust the trend and sell the news. And, I think that I would just say that I'm targeting a level closer up here, 50% retracement of this drop. It's on a weekly. I'm trying to take it Friday to the low. But I want to mention this is FXI. And, China might be able to do a few more things to boost their economy here. But the downtrend in the Chinese stocks, I think, is still, pretty solid. And I want to just mention that we might be getting a little bit of an opportunity in that. Another thing I wanted to mention was we had talked about home builders, and this is the Philadelphia housing ETF, housing index. And I want to just put on now MACD because I'm going to take off RSI because this now, in my view, is a case of too much optimism. We have a pretty significant bearish divergence here on the housing. We have a new high, and it's a pretty weak high. It's a false breakout. You might be able to call that a little bit of an island reversal. And then if you look here, MACD going lower. So, I think this is actually a pretty ugly chart pattern for home builders. We had talked about this kind of breakout back here as it happened. I think there's been a lot of optimism, but now with the Fed potentially a little bit more hawkish, it's a little bit, more difficult, I think, to kind of maintain that. We had some poor numbers yesterday from DR Horton, but this looks to me like a potential a bearish divergence, false breakout with the potential for months of weakness. I am going to be setting price alerts back here on these highs and maybe looking to revisit this trade on the long side, in the second quarter.
Is that how you often use prior highs for either setting alerts and being patient and waiting for a more moment where that high is now support? Is that what you're often looking for?
Yeah, and I would say that in this case, I mean, you can see that this level had a pretty clear sort of relevance. It was a place where the market paused before it broke out. So this to me looks like a pretty strong level. It was confirmed by this consolidation here. So yes, I think in this case, people looking to buy, that's the logical place they're going to look. I think you also had something like that here. See, so yeah, we actually. Yeah.
I would just say to that, it's one of the reasons why I love technical analysis. Is it's just a, if anything, it's a sort of it's a planning mechanism. Right now you've got your level, and now you can wait patiently. There's no rush trade. There's no bad. This is my plan. Now I wait. Exactly. Add an alert. So I think that this demonstration for the housing sector is, it's more than just examining the housing sector. For all the viewers, you just got a nice insight into sort of the patience you can take for finding that level to watch from David. So noted for me, and I'll be watching that as well. Let's look at DoorDash. How I missed that this was running.
This thing is just squeezing. I mean, it's been interesting. We talked about Uber last time, and I think that this is, even though I just said everything is enterprise, there are still some of these newer consumer names, and I think it's important to just kind of see some of these names. That this had a strong earnings report here, and I'm just kind of watching to see if this thing keeps running toward earnings. But I want to point out because it seems to me at this point to be in a very tight uptrend, moving toward earnings. And this one just popped up because it was near a high and it pulled back. I found it yesterday using TradeStation because it was near a high and basically pulled back to the 8-day exponential moving average. Like I said, at this point in time, like the chart patterns are not on individual names are not working maybe as much as I would normally want to see. But the main thing for me is just go back to where we were. And I want to just very quickly run through, if I might, these points about the S&P 500, and just if you don't mind, can I just quickly? Sure. I want to mention these points. All right, basically, absolutely. I want to say that in a bull market, sellers get punished. I think it's important to realize that. Early this year, there were a few warnings from the semiconductor industry. I think it was Samsung had bad earnings. There was another company warned, and then basically it pulled back a little. And then after that, everything was positive. So if you look at different measures of sentiment, the little pullback we had, kind of this little pullback, optimism actually fell significantly and people started getting really scared really fast. That is symptomatic of a bull market where basically people are skittish and they shouldn't be scared, but they are. And so I think that's something that sellers get punished in a bull market. And so then what's interesting is I mentioned the cash on the sidelines, but then what's also interesting to see that new things are coming out of nowhere, like the PC market is now coming to life in addition to AI. So you have a very old tech and a new tech coming together. If you look at the S&P, I don't have it in front of me right now, but if you look at the S&P PMI, which is an economic report that came out today, it basically shows that output is improving the economy at the same time, price increases are slowing to the lowest level since pretty much early 2020. So we continue to see improvement on inflation. At the same time, production has really slowed down. And it's at a spot now where we can now see an uptick in economic activity and production with lower cost at the same time. And that's Goldilocks. And at the same time, that means that when companies going forward, their profit margins are likely to improve and they cut costs on top of that. So there's a report that basically said profit margins are now at the lowest in over 3 years, according to FactSet. Those seem to be turning up. And if you look at even something like Netflix, what are they doing? They're playing games with their business to make it more profitable. That is the sort of stuff that happens in a bull market. They're able to pull rabbits out of the hat to kind of drive things forward, and they're able to find ways to make money again. And that is an exact example of what margin improvement is going to look like. When you look at, I want to also mention that, like, we go back to the 90s. The 90s was a great job market. The early 2000s, people said it was a jobless recovery. So we've basically been emotionally scarred in this country about the economy ever since 2000. First, we had a jobless recovery and people were unhappy about the labor market. Then we had the financial crisis. Then we basically had the Great Recession. Then we had COVID. Then we had inflation. So we have had basically a stream of negativity for a long time here, and all those things are now going away. So I think it's important to kind of to realize that And again, if the Fed doesn't cut rates right away, we saw an incredibly strong retail sales number. We saw, jobless claims going to the lowest level in over a year, both of those last week. At the same time, some of these inflationary things comes down. The Fed is also recognizing that some of their inflationary data is behind the curve because of the way they use rents. So as we go forward, we're likely to see rents come down. Those basically account for a third of inflation. So as inflation kind of just keeps improving, at the same time the economy gets better, what it means is even if the Fed delays cutting rates, what that means is there's going to be more positive catalysts down the road. The longer the Fed waits to cut rates is actually more bullish, because it means that as the market starts to weaken, they can just say, all right, we're going to cut. And then that becomes a whole nother potential for something that's kind of positive. So I see all those things. The last thing I will mention is Friday's consumer sentiment report showed that people seem to be really starting to appreciate these factors I'm talking about, that this huge wall of negativity is starting to go away. And so you put all those things together, and I think that's actually, like I said, the Tesla chart showed you the fundamentals before they happened. Well, that's what we're now seeing in this S&P 500 chart, in my opinion.
David, if you had a physical microphone, I would tell you to drop it, because that was a mic drop moment. That was awesome. And there's so much to unpack there. I want to I would replay it, because there's 10 things that were on my mind, two of which I have right now that I wanted to comment on quickly. Was, in bull markets, sellers get punished. What a cool comment. I haven't heard that before. And it's just to essentially understand that better. They're having so much FOMO. Is that the right way to think about it? Like they're just missing out on what could have been?
Well, I think it's I think it's more the fact that that your fears were wrong. So basically you buy AMD, it goes up 10%, and you're like, oh, I'm so glad I take my profits. And it goes up another 40%. And you're like, why did I do that? I did that. I have to admit, I sold AMD way too early. And there you go. There's examples of these sort of things. And I think that this is across the market, where people basically, they're skittish and scared, and they're not sitting and being complacent. As the market matures and gets complacent, you see people sitting on leverage, and they're like, I'm just going to be safe and blah, blah, blah. And you get careless and stupid. I would say that bull markets end with complacency to a certain extent. You get to this point where at the end of a bull market, you actually start to see leverage goes up. And then you start to actually see slower and slower gains. And then what happens is all of a sudden people start selling, and then it cascades. And because there's so much leverage, then you get this massive implosion. And but those follow months and months of upside when people get complacent. And right now we're at that point where it's the opposite of complacence. It's, I'm still skittish, I'm still scared. So that's what I mean, is that sellers get punished in the beginning because they're scared when they should be more, letting it ride.
One more comment for you too, based on the mic drop moment that you had, is the aspect of Netflix, because I do think it ties into a lot of what you're saying, and the fact that a company like Netflix can take those types of risks or pull those levers to drive business. They both have gotten into video games, because now there's a Netflix app. You can play Grand Theft Auto, all these games. And I just saw that they bought the live streaming rights to WWE. So now they might be in they might be making a TV network. I just wanted to point that out, because I also found that to be rather interesting, and it ties into what you were saying about, as this bull market gets going, these companies can start to push new levers. Super interesting. So if you have anything else to add to that.
And it's ultimately a margin story. I think we now need to think about, this is going to be a margin story. When there's strong demand, when companies, we've seen basically weak orders in the industrial economy. As those improve, margins will improve. There's a correlation between those things. And as economic activity improves, so if we're at a bottom in margins, it actually means that earnings could surprise to the upside over the remainder of this year.
It's a margin story. Yes.
It's a margin story. And right now we're expected to have about 12% earnings growth this year. So if you have upside in earnings surprises, you could have, it could be more than that. And then you look at the S&P, like I said, that level, that top of that long-term channel, it might not be really as extreme as it might sound if you factor in earning surprises and multiple expansion.
Well, David, I feel like this might be the right way to end the show, especially as we are just crossing that hour marker as well. Unless there's any other last tidbit you want to add, I will say for me, one thing I walk away with is, is this the margin expansion bull market, which is very, very interesting that I'll be paying attention to. Any other final commentary for viewers to pay attention to? And our next show will be next month. So make sure everyone you subscribe, follow TradeStation, all that good stuff. Any final thoughts to add?
I would just remind people that there are these events coming up of GDP in the morning, and then the Fed at the end of the month and everything else, and just to realize that in the near term, up 5 days, just to be aware of that. And even if sellers get punished, there you still hogs still get slaughtered. So let's just not be complacent at a time like this when we have the GDP and everything else coming in the morning.
Great. I'm putting that in the chat because that is a really nice way to end the show, especially as we kick off 2024. These are the events on the horizon. As David said, you've got Fed events, GDP, and of course, as we started the show, earnings coming up, Tesla happening tonight. David, thank you again for the show. For all of our viewers, if you're just jumping in, rewind this back to the start. You won't want to miss this show as you start your 2024. Pop your headphones in, play it in the background. You're going to get a lot of good insights about the markets. The show is sponsored by TradeStation, so be sure to follow their account. David runs the TradeStation account on TradingView, so you are meeting the man behind all of those ideas. So be sure to give them a follow. Also, one more quick note. He showed us his scripts today. You can go get the TradeStation scripts as well. Link is in chat. David, thank you so much, and we'll be talking to you next month.
Thanks a lot, Steph. I'll see you.
See you later.